Not sure if you were watching the bond market last night, but I checked in about 9 p.m. Pacific, and the 10-year note was up 22 basis points. The 30-year note was 5%. The 10-year had ratcheted up to 4.5%. These are violent moves, especially after hours. It makes me think that something in the bond market might be breaking. Some people are saying China is selling. Some people are saying some fund that was perhaps leveraged up to 100x in what is called the basis trade, much like the yen carry trade. There's a basis trade in the US, may have blown up. But one thing is certain: the goodness that we saw the last 3 or 4 days from mortgage rates falling is over. Now, is it over long term? Will this prove to be a bump in the road? But folks, it would not surprise me if mortgage rates hit 7%. It's funny for me to say that out loud because it was just a week ago I gave up on my call for 7% mortgages. So again, the bond market is telling us something bad happened yesterday evening. We don't know, as of yet, know what, but any violent move like that is certainly a sign of panic, aka forced selling. It's interesting to look at the bond market with rates going up when the stock market is clearly screaming recession. It's kind of it doesn't make sense. But we're going to talk more and more about that because we're getting a clearer and clearer picture of what will likely transpire by the earnings season, which kicks off with the big banks on Friday. And I think, frankly, gets worse from there. Just in the last 24 hours, we had Delta Airlines. Delta Airlines actually reported pretty good numbers this morning. In fact, they beat on revenue, which means they sold more tickets for higher prices. And they beat on earnings, which means they made more money than expected. However, and it is this however that is perhaps the most important and likely to be repeated for many earnings, we withdraw guidance for the rest of the year. One of the things that I don't know if you're aware of that a lot of most, if not all earnings call do is they basically not only give you your report card, how they did, right, how they did the previous quarter, but they also try to tell you how they're going to do, how they're going to do next quarter, how they're going to do the rest of the year. And I believe what is going to happen in this man-made event is we're going to see most, and by most, let's put a number on this. It really could be as high as 60 or 70%. Excuse me. We could see 60% of publicly traded companies withdraw guidance. That's generally not a good thing, right? When companies pull guidance, it means a lot of things are changing, and they have, of course, a lot of uncertainty. Uncertainty is quickly becoming the word of the year, right? Transitory might have been the word of the year in past. This year, it is going to be uncertainty. So again, we need to watch out for that. But not only did Delta Airlines pull guidance, but Walmart pulled guidance. So again, I think it is going to be a very messy earnings season. We are going to see companies pull down expectations, no doubt. Many of them will not even give expectations. Then, of course, you go to the earnings multiple and the expected earnings for the S&P 500, and we're seeing more and more analysts call something like 4,600. So it is going to get interesting. Don't know if you know this, but Trump's tariffs have gone into effect as of this morning at 12:01 Eastern time, I believe. I think it was Eastern, including a 104% tariff on Chinese goods. Not to be outdone, this tit for tat, this trade war is escalating. China in the early hours responded with an additional 50% tariff on U.S. goods. So if you're keeping track, U.S. has a 104% tariff on Chinese goods. China has a 84% tariff on U.S. goods. Also, not to be outdone, the EU has come out with their first set of retaliatory tariffs focused on steel and aluminum, with promises of more to come. This trade war has legs. It is certainly disrupting the worldwide economy. This is not a US only phenomenon by any stretch, but it is changing perhaps more things than many had expected. Here's a quote from Scott Bessent. "It is Main Street's turn now, not Wall Street." The context of that quote was an interview where Scott Bessent basically said Wall Street has enjoyed the riches for 40 years and we want to go back to Main Street, which I think is admirable, obviously. But one of the things that doesn't make logical sense to me is when you talk about Apple, right? Apple is often talked about, and more specifically, the iPhone is talked about. There is a thought that why doesn't Apple make iPhones in America? To which I say, it is certainly possible. If Apple wanted to, they could create manufacturing plants with robotics and absolutely, without question, make iPhones in America. But let's play that out one more step. I suspect, again, I've heard these numbers thrown around, that these manufacturing plants to make iPhones would cost on the order of $20 to $30 billion. And, oh, by the way, not be up and operational for 4 years. I'm just saying. The other thing that would likely come out of a U.S. manufacturing plant for iPhones is an iPhone that is, without question, amazing. But it would come out with a price tag north of $3,000. That's just math. It's just math. So again, I think it is an interesting riddle to figure out. And I guess the last thing is, if you think about a factory in China making iPhones versus a factory in the US making iPhones, I'm going to guess that the plants in the United States have let's say 1/150th the number of people. I have never been to a Chinese manufacturing plant, so this is just guessing based on videos I've seen. In China, they have a lot of individuals putting on little screws and things of that nature. I suspect in the United States, that would be all robotic. Now, yes, there'd be more employment. There'd be engineers, there'd be repairmen, maintenance, all of that. But I think the headcount inside a US-made manufacturing for iPhones would be predominantly robotic, with maybe a skeleton crew to make sure it keeps going. So I just think we have to play out the big picture. So again, one of the things that I put here is how many companies will pull guidance. And again, I put that down before we got the first one this morning, Delta and Walmart, but it is going to be interesting. One of the things that we did get today on Wednesdays, we always get mortgage app data, and it is very interesting. We once again have evidence that rates matter. What happened last week, folks? Well, basically Wednesday, Thursday, and Friday, you saw rates crater. So guess what happened to mortgage applications last week? They went up 20%. Mortgage applications went up 20%. Refi went up 35%, and purchase went up 9%. So again, we have once again learned that the American public will start buying as rates fall and get closer to 6%. I think last week rates were roughly 6.5%. And 6.5% was enough to pull some buyers off the sidelines. But again, what have we seen in the last 36 hours? Well, the 10-year note is now almost 4.25%. Mortgage rates will likely be at or close, near, at, or over 7% by the end of the day. And we have also learned that 7% mortgage rates are bad. So we should expect mortgage applications, refi demand to crater, collapse, fall. This is becoming painfully obvious. Below 6.5, good, right? You have a 6.5% mortgage rate buy downs, you're in the fives. Something with a 5 handle, good. Something with a 7 handle, bad. That is what we are learning over and over again. We got some comments from some Fed folks. We got Fed President Kashkari. He's always good for a quote or two. Here we go. The bar for changing interest rates has gone up because of the magnitude of tariff increases. Folks, we are starting to see more and more folks get on board with my call of 0 rate cuts in 2025. In fact, PineBridge, which is a money management firm, actually favors cash over treasuries as they bet on the Fed staying on hold all year. PineBridge is actively building their cash pile, which I think is interesting. Again, the chances of the Fed cutting in the near term, based on what these tariffs will do to inflation, are not great, no matter how much people beg for Powell. Don't forget, it's crazy. You know, this would be a fun bet if we could kind of play this out together. I believe if the Fed cut rates today, like emergency meeting, Fed cuts a 1/4 point, Fed cuts a half, it would not shock me if once again the 10-year note went up. Remember, folks, the Fed has already cut 100 basis points, but rates went up. So a Fed rate cut is not panacea. It's not always taking rates lower. People need to remember history. At this point, I don't know how we don't have a recession. I'm hearing from more and more business owners, more and more consumers, more and more investors. There's a real drop in consumption. There is a real negative wealth effect. Folks, I don't know if you've seen it. Actually, you haven't seen it. It comes out today. The real estate market in Seattle, aka King County, is feeling the wealth effect, right? If you have a lot of buyers who have suddenly seen 20, 30, 40% of their stock wealth disappear, that is going to cause demand to dry up. Negative wealth effect is real. And then lastly, what we are seeing is capital investments, frankly, investments of any kind, are being, at least in the short term, held back. If you have investment held back, you have businesses holding back, you have consumers holding back, I don't know how Q2 is anything other than a negative GDP print. Now, this could all change. We could get through, maybe Q2 is negative. Maybe in Q2 we get this promised tax reform, deregulation. In Q3 is not negative, certainly possible. But again, Q2 is shaping up to be, I think it's fair to say, a weak quarter. Kevin O'Leary coming out, Mr. Wonderful from Shark Tank. He's out with some interesting headlines. Mr. Wonderful says, I would go 400% tariff on China. Kevin O'Leary goes on to say that China cheats, steals intellectual property, never done anything, WHO. And Kevin O'Leary goes on to say he has experience in China running businesses. You can't sue, you can't go through the courts. And Kevin O'Leary is basically saying hit those cheats with a 400% tariff. So as of this morning, I don't know if you did the math, the U.S. has 104%. So Kevin O'Leary says not enough, which I thought was interesting. Goldman Sachs following JP Morgan. Goldman Sachs ups their recession odds from 35% to 45%. JP Morgan is all the way up to 60%, which is, again, interesting. I think it is very clear that the tariff in chief is a gentleman named Peter Navarro. Peter Navarro is part of, obviously, Trump's inner circle, and he seems to be the one pushing for aggressive tariffs. Obviously, Peter Navarro and Elon Musk are having their war of words. I think it will be interesting to see if Peter Navarro is the first person to leave Trump's administration, or does he stay put and dig his heels in? I think that bears watching. I think it will be interesting to watch. Next up, we've got some Fed speak, and we will wrap up this great daily financial news. We'll go with Daly and Goolsbee. First, Daly, Fed President Daly. Fed policy is in a very good place, modestly restrictive. All right. We have time to study things carefully. Okay. We do not have complete clarity on tariffs. I think that's fair. Uncertainty we have now can be worked through. A little concerned about inflation picking up. Again, we're starting to see more and more Fed presidents talk about inflation versus the job market. Fed President Goolsbee, businesses won't invest when the rules are not clear. That is exactly what I'm hearing from business owners. Tariffs could lead to bankruptcies of suppliers, right? People in middlemen in this process. And then finally, tariffs were way bigger than the Fed expected. At the end of let's close with one more. Good old Nick Timiraos from the Wall Street Journal. Often Meet Kevin calls Nick Nicky Leaks, which I think is cute. Often seen as the unofficial mouthpiece for the Fed. This is what Nick said yesterday in a tweet. The Fed is in a no-win situation. Prices are likely to rise. Uncertainty is freezing hiring and CapEx, which are both bad for growth. If we cut rates, maybe after the labor market breaks. No chance the Fed cuts in May, folks. Shoot, I'm starting to think June might be at risk, but we'll just deal with the next meeting. Don't forget, we are going live 8 a.m. on Sunday inside school. I would love to see you there. I would love to see you inside school. We are building the #1 community for real estate investors, new and experienced. We are in there sharing, networking, asking questions. We have 6 different accountability groups that you could join and be a part of. We got thousands of dollars in free education from lots of people like Ty, Jason, myself. Again, get in the community. As you see the banner on the screen, it's only 67 pennies a day. This is not some get-rich scheme. This is just a place to be, to network, ask questions, get educated, do the work. I hope you have a great day. Take care. Later.